Welcome to Chapter 21, where we'll dive into the principles of inventory management and how to account for inventory costs effectively. This section, within the broader scope of managerial accounting, focuses specifically on inventory management techniques, including just-in-time systems, as well as simplified costing methods. Understanding these concepts is crucial for making informed decisions that can improve operational efficiency and cost control in any business that handles inventory. Let's explore how these principles work together to optimize inventory processes and accounting practices. When we talk about inventory decisions, it's important to understand that we're balancing more than just the purchase price of goods. There are 6 key categories of inventory costs that we need to consider. First, purchase costs are straightforward. They're the amounts paid to suppliers for the goods themselves. But beyond that, there are ordering costs, which include everything involved in placing, receiving, and processing those purchase orders. Next, we have holding costs. These cover all the expenses of storing inventory, like insurance, financing, and handling. Then, there are stockout costs, which can be significant. They include lost sales, rush shipping fees, and production delays that happen when inventory is unexpectedly low. Quality costs are another vital piece. These include prevention efforts, inspections, rework, and costs related to defects. Finally, shrinkage costs account for losses from theft, damage, obsolescence, or errors in recording inventory. Understanding these 6 categories helps us manage inventory more effectively, whether we're using traditional methods, just-in-time systems, or simplified costing approaches. It's about balancing all these factors to optimize overall costs and operational efficiency. When we talk about economic order quantity, or EOQ, it's all about finding the right balance between 2 main types of costs, ordering costs and holding costs. Ordering costs are the expenses that come up every time we place an order. This includes things like preparing purchase orders, receiving the goods, inspecting them, and processing the invoices. Each order involves these costs, so ordering frequently can add up. On the other side, we have holding costs, which are the costs of keeping inventory stored over time. This includes storage fees, insurance for the inventory, risks like obsolescence where items might become outdated or unsellable, and the cost of capital tied up in that inventory. Holding too much stock drives these costs higher. EOQ helps us strike a balance between ordering costs and holding costs, minimizing the total expenses related to inventory management. By using this approach, businesses can order the right amount of goods at the right time, avoiding excessive storage or frequent ordering. This is essential in methods like just-in-time and simplified costing systems where efficient inventory control is key. Here we have the Economic Order Quantity Model, or EOQ for short. This model helps us determine the optimal order size, striking a balance between the costs of ordering and holding inventory. The formula itself is EOQ equals the square root of 2 times demand times ordering cost, divided by holding cost. Let's break down the variables. D stands for demand, which is the annual quantity required for the item. S is the ordering cost, meaning the expense incurred each time an order is placed. H represents the holding cost, or the annual cost to keep one unit in inventory. EOQ helps identify the perfect order quantity to minimize total inventory costs by balancing the frequency of orders with the amount of stock held. It's a crucial tool in inventory management, and it plays a key role in approaches like just-in-time and simplified costing methods. Understanding EOQ allows businesses to manage inventory efficiently and cost-effectively. Now, let's talk about how we apply the EOQ model in practice. EOQ helps us find a balance by turning key factors like demand, ordering cost, and holding cost into a practical order size. Imagine a situation where we have an annual demand of 10,000 units, an ordering cost of $80 per order, and a holding cost of $5 per unit per year. Using the EOQ formula, we calculate the optimal order quantity to be about 566 units per order. What does this mean for us? If we order too little, we'll end up placing too many orders, which increases our ordering costs. On the other hand, if we order too much, we'll incur higher holding costs from storing excess inventory. By ordering near the EOQ, we minimize total inventory costs, finding the sweet spot between ordering and holding expenses. This balance is crucial for effective inventory management, just-in-time strategies, and simplifying our costing methods. Let's talk about some common errors in calculating the economic order quantity and their real-world impact. The most critical issue is using wrong demand estimates. If the demand forecast is too high or too low, the EOQ calculation is based on incorrect annual usage, causing order sizes that don't match actual demand. This leads to problems like overstated demand, which increases average inventory and carrying costs, or understated demand, which raises the risk of stockouts and forces rush orders. Another frequent mistake is misestimating ordering or holding costs. Managers might overlook hidden costs like setup, handling, financing, storage, or obsolescence when inputting data into the model. This results in EOQ recommendations that are systematically off, driving total costs higher than necessary. Finally, EOQ assumes stable lead times and supply conditions. It works best when replenishment is predictable, but in reality, delays, shortages, and variability happen. Even with a mathematically correct EOQ, companies often need to maintain safety stock, buffer capacity, or coordinate closely with suppliers to prevent disruptions. Understanding these errors and their impacts is essential to managing inventory effectively and keeping costs under control. Now, let's discuss the relationship between EOQ, or economic order quantity, and performance evaluation. One key challenge is resolving conflicts that often arise between EOQ calculations and various performance metrics. For example, there can be a tension between EOQ and inventory turnover targets. EOQ might suggest ordering larger quantities less frequently for cost efficiency, but that can conflict with goals focused on high inventory turnover. Similarly, balancing order efficiency with maintaining low stock levels can create a dilemma. Larger orders reduce ordering costs but increase holding costs and risk of excess inventory. Another common conflict is between purchasing savings and carrying cost discipline. Buying in bulk can yield discounts but raise inventory carrying costs. To address these conflicts, it's important to align incentives thoughtfully. Using balanced metrics that consider ordering, holding, and service level outcomes helps create a more holistic view. Setting shared targets across purchasing, operations, and finance encourages collaboration rather than siloed decision-making. Finally, managers should be evaluated based on total relevant costs, rather than isolated inventory measures, ensuring decisions support overall company performance. This comprehensive approach supports effective inventory management, facilitates just-in-time practices, and simplifies costing methods for better outcomes. Just-in-time purchasing is a strategy companies use to streamline operations and improve efficiency. One of the main reasons firms adopt JIT is to cut waste, enhance workflow, and free up cash that would otherwise be tied up in inventory. By keeping lower inventory levels, companies save on storage, insurance, handling, and costs associated with obsolete stock. This means less money is spent on maintaining large inventories and more funds are available for other parts of the business. Another key benefit is improved cash use. Since capital isn't locked into materials sitting idle on shelves, companies can better allocate cash toward operations and growth initiatives. This financial flexibility is crucial for responding quickly to market changes. JIT also speeds up operating flow. Because deliveries are frequent and closely aligned with actual demand, there's less waiting time throughout the supply chain. This leads to smoother production processes and quicker response times. Lastly, JIT enforces higher quality discipline. Managing smaller lot sizes makes it easier to spot defects early. This creates a strong incentive for both suppliers and internal teams to address problems promptly, improving overall product quality. Together, these benefits make just-in-time purchasing a powerful approach to inventory management and cost control. Now, let's focus on just-in-time systems and how they impact the supply chain. The core idea behind JIT is that the supply chain must deliver exactly what is needed, precisely when it's needed. This requires a few critical components. First, suppliers must be reliable and able to consistently provide high-quality materials. Without that consistency, the whole system can break down. Second, timing has to be impeccable, with frequent deliveries coordinated closely to match production schedules. This keeps inventory levels very low, minimizing storage between each step of production. By doing this, companies can streamline inventory management and simplify costing methods, making operations more efficient overall. The key takeaway here is that JIT depends heavily on a well-coordinated, responsive supply chain. Here, we're comparing two fundamental planning systems, Materials Requirements Planning, or MRP, and Just-in-Time, known as JIT. These represent two very different production approaches based on distinct underlying assumptions. Starting with MRP, it's forecast-driven scheduling. Production is planned based on a master schedule, with material needs calculated in advance. This method uses a push system, meaning production is pushed forward according to the plan, regardless of immediate demand. On the other hand, JIT follows a demand-pull scheduling approach. Production only begins when the next process or the customer signals a need, which means it's more responsive and just in time to actual demand. One key difference is how they handle inventory. MRP uses inventory buffers, extra materials and work in process to absorb uncertainties and protect against disruptions. This acts as a protection strategy by maintaining higher inventory levels. Conversely, JIT aims to minimize inventory. It maintains very low buffer levels, which helps expose problems quickly and reduces carrying costs. This lean approach focuses on efficiency and waste reduction. Supplier coordination also varies between the systems. MRP plans orders in batches based on system calculations and lead times, coordinating suppliers on a periodic basis. In contrast, JIT relies on frequent, synchronized deliveries where suppliers work closely with production on timing, quality, and small lot deliveries, fostering stronger relationships. In summary, MRP is a push-based, forecast-driven system with inventory buffers buffering uncertainty, while JIT is a pull-based, demand-driven system that minimizes inventory and emphasizes close supplier collaboration. Understanding these differences is crucial for selecting the right system based on production goals and operational environment. Just-in-time production is all about efficiency and responsiveness. The key idea is to move only what is needed, exactly when it's needed. This is called pull scheduling, where production begins based on actual demand rather than forecasts, which helps eliminate excess inventory. Building strong supplier partnerships is crucial here because reliable and frequent deliveries keep materials flowing smoothly with less stock on hand. Standardizing workflows is another important feature. By following consistent steps, we reduce variation and speed up daily operations, making the process more predictable and stable. Quality is also a top priority. Problems are identified and addressed immediately instead of being passed along the production line, preventing bigger issues later on. Continuous improvement plays a huge role in just-in-time production. Small, ongoing changes help remove waste and steadily strengthen performance. Finally, inventory management is simplified through just-in-time methods and clear costing techniques, which altogether contribute to a lean, efficient system that responds quickly to real demand. Just-in-time, or JIT, production brings several important benefits that really help improve overall performance. First, it reduces waste by cutting down on overproduction, unnecessary handling, scrap, and idle storage. This means resources are used more efficiently, and we avoid excess costs associated with these inefficiencies. Another key advantage is lower inventory costs. By maintaining smaller stock levels, companies can save on carrying costs, reduce the need for storage space, and minimize the risk of inventory becoming obsolete. JIT also leads to improved quality because defects are identified and addressed much earlier in the process. This early detection helps prevent bigger problems down the line, ensuring a higher standard of output. Finally, faster response times are a major benefit. With shorter lead times, production can be more flexible and responsive, supporting smaller batches and quicker deliveries to meet customer demands more effectively. This combination of benefits makes JIT a powerful approach for streamlining manufacturing and creating more value. Traditional inventory costing presents several challenges that companies need to manage carefully. One major issue is allocating overhead costs accurately. Since overhead expenses must be distributed across various products and production activities, it can become quite complex. Additionally, tracking work in process requires attention because materials, labor, and overhead move through multiple inventory accounts throughout production. Maintaining detailed records is critical in this system. Accuracy hinges on making extensive entries, managing timing properly, and performing thorough reconciliations. When inventory turnover is rapid, this traditional system can feel cumbersome and slower than the actual production flow, creating inefficiencies. This raises an important question: can we simplify this process? This question naturally leads us to consider backflush costing and other leaner accounting methods that support inventory management, just-in-time production, and simplified costing. These approaches aim to streamline accounting efforts, making the system more aligned with fast-paced manufacturing environments. Now let's talk about backflush costing, which is a method that delays recording costs until production is completed or the goods are actually sold. Unlike traditional costing systems where costs are tracked closely at every stage, like purchasing materials, work in process, and finished goods, backflush costing simplifies this process by assigning costs near the end, reducing the number of accounting entries needed. Despite fewer entries, the overall inventory flow remains the same. This approach works particularly well with inventory management systems like just-in-time, where materials arrive exactly when needed, making costing more streamlined and efficient. The key takeaway is that backflush costing minimizes tracking effort while still providing accurate cost information once production is wrapped up. Now, let's take a closer look at the three versions of backflush costing, a method designed to simplify inventory management and costing in just-in-time environments. In version 1, the trigger occurs right at production start. Here, the key accounting entry moves materials and conversion costs directly to the cost of goods sold. This approach minimizes tracking, assuming that goods will soon be completed and sold. Version 2 triggers at completion of the product. The accounting entry shifts materials and conversion costs into finished goods inventory first. This reflects that the product is now complete but not yet sold. Finally, version 3 delays the trigger until the point of sale. At this stage, the finished goods are then expensed as cost of goods sold. This version provides more control over inventory valuation but still simplifies the costing process. Each version balances simplicity with the timing of cost recognition, supporting efficient inventory management while aligning with just-in-time principles. Understanding these differences helps in choosing the best approach for a given operational setting. In backflush costing, instead of tracking costs through each step of work in process, we assign all costs when the units are finished. Here, we use a standard cost approach, where direct materials cost $30 per unit and conversion costs are $20 per unit, making a total of $50 per finished unit. For example, if 1,000 units are completed in a period, the total cost assigned is $50,000, which is calculated by multiplying 1,000 units by the $50 standard cost. The backflush entry records $50,000 to finished goods and credits materials and conversion costs for the same amount. This method eliminates the need for detailed tracking of work in process throughout each stage. Instead, costs are flushed back from the finished output, simplifying inventory management and aligning well with just-in-time production systems. In this slide, we're comparing simplified and traditional costing systems, focusing on the trade-off between detail and speed. Simplified costing uses fewer accounts and tracks less work in process, which helps companies close their books faster and generate reports quickly. This approach is especially effective in just-in-time environments where speed and efficiency are key. On the other hand, traditional costing involves more detailed allocations and multiple accounts across different inventory stages. While it requires more time to reconcile inventory flows, it provides a higher level of detail, which is essential for companies that need precise cost tracking. Additionally, backflush costing, a part of simplified systems, reduces the accounting trail, allowing companies to close faster with fewer inventory transactions. Essentially, the choice between simplified and traditional costing depends on whether a company prioritizes speed or detailed accuracy in its inventory management. Lean accounting is all about aligning how we measure performance with the principles of lean operations. Instead of complex reports and unnecessary controls, it simplifies reporting to clearly show how the work we do creates real value for our customers. One key aspect is eliminating waste. This means cutting out non-value-added tasks, reports, and transactions that only slow down decision-making without actually improving how we perform. Another important point is the value stream focus. Rather than looking at costs and results in isolated departments, lean accounting measures everything based on the flow of work across the entire value stream. This holistic view helps us understand the true impact of our processes. Finally, customer value is at the core. We emphasize metrics that reveal whether our processes deliver the quality, speed, and reliability that customers truly want. This often involves practices like inventory management, just-in-time production, and simplified costing methods, which all work together to support lean principles effectively. Here we focus on key lean accounting practices that help streamline financial management in a lean environment. First, value stream costing tracks costs by value stream rather than by department, giving us a clearer picture of where resources are truly consumed. Next, cell-based accounting measures performance exactly where work flows, aligning accounting with actual operations. Visual management is crucial, using easy-to-read, visible measures that everyone can quickly understand and act upon. Standard costing reduces our reliance on complex variance-driven reports, simplifying cost analysis. Lastly, continuous improvement metrics concentrate on lead time, quality, and flow gains, encouraging ongoing enhancements. Together, these practices support inventory management, just-in-time principles, and simplified costing methods that drive lean success. Here, we're focusing on the concept of value stream costing, which is central to lean accounting. The core idea is that instead of breaking down and tracing costs to every individual process, department, or transaction, companies group all the direct and support costs around an entire product family and the flow that delivers it. This approach simplifies cost tracking by assigning costs to the complete value stream as a whole. By doing this, performance becomes much easier to see, manage, and improve because you're looking at the bigger picture rather than getting bogged down in detailed transactions. This ties closely with inventory management and just-in-time production, both of which emphasize efficiency and waste reduction. Together, these elements form simplified costing methods that align well with lean principles, helping organizations focus on delivering value while controlling costs effectively. Now, let's talk about the tools that make performance visible, which is a key aspect of lean accounting. One important tool is dashboards, which provide a simple, consolidated view of key value stream results. This helps everyone quickly understand how things are going at a glance. Another essential tool is Kanban boards. These visually show the status of workflow and highlight any bottlenecks immediately, so the team can address issues before they escalate. Real-time metrics are also crucial because they allow us to track quality, delivery, and workflow continuously as work progresses. So, what does this visibility enable? When performance is clearly visible, teams can see potential problems early on, make faster decisions, and correct course quickly. This leads to earlier error detection, quicker corrective actions, and better alignment on daily tasks. All of this supports more efficient inventory management, just-in-time production, and simplified costing methods, which are central to lean accounting. Visual management like this fosters a more transparent, responsive, and aligned working environment. Let's talk about the benefits of lean accounting and why it's such an important approach. First, there's cost transparency. By tying costs directly to value streams, it becomes much easier to understand how our operations are performing financially. This clarity helps everyone see where the money is really being spent. Next, faster reporting is a huge advantage. Simplified measures cut down delays and provide managers with timely financial feedback. They don't have to wait weeks to know how things are going. Lean accounting also drives waste reduction. Instead of rewarding inventory buildup, the reports highlight non-value-added activities, pushing teams to focus on eliminating waste. Another key benefit is an improved quality focus. By emphasizing flow, defects, and customer value rather than just absorption costing, we align financial measures more closely with what really matters to customers. Because of this, decision-making gets better. Managers can clearly and quickly see the financial impact of process changes, which supports smarter, faster choices. Employee engagement benefits too. Simple, visual measures are easier for teams to understand and use in their continuous improvement efforts, fostering greater participation and ownership. Overall, lean accounting makes performance easier to see, quicker to act on, and much more aligned with lean operations like inventory management, just-in-time, and simplified costing methods. This approach truly supports a leaner, more efficient business. This slide highlights the important connections between just-in-time operations, backflush costing, and lean accounting. JIT operations enable a low inventory environment and promote a smooth flow of materials, which reduces the need for detailed tracking of inventory. This simplification supports the use of backflush costing, where costs are assigned to products only after production is complete, cutting down on complex record keeping. Lean accounting, in turn, reinforces these principles by using simple measures and focusing on value streams, which helps align accounting practices with lean behaviors in the organization. Together, these approaches create a streamlined system for inventory management, costing, and operational efficiency. Now, let's talk about some common challenges we often face and how we can address them effectively. One major challenge is supplier reliability. To mitigate this, it's important to work with certified suppliers, maintain tighter schedules, and share quality data transparently. Another challenge is demand variability, which can disrupt planning and operations. We can tackle this by improving our forecasting accuracy, shortening lead times, and keeping small strategic buffers to absorb fluctuations. Cost volatility is also a concern, and to manage this, we should regularly review our standards, lock in key contracts to stabilize prices, and closely track value stream costs. Additionally, adopting inventory management techniques like just-in-time and using simplified costing methods can help us stay agile and cost-efficient while managing these challenges. Here, we're summarizing some important concepts from inventory management and costing methods. First, the economic order quantity, or EOQ, helps balance the costs of ordering and holding inventory to determine the most economical order size. This balance is crucial because ordering too much or too little can increase costs. Then we have just-in-time purchasing, which focuses on cutting inventory levels, reducing waste, and improving both quality and responsiveness. It's all about getting the right materials at the right time. It's worth noting that errors in EOQ calculations matter less when the cost estimates are accurate, but if the data is off, it can lead to poor decisions and increased expenses. Moving on, material requirements planning, or MRP, relies heavily on forecasts and production schedules, while JIT is driven by actual demand and requires tight coordination along the supply chain. Backflush costing is a simplified accounting technique where detailed cost tracking is delayed until production is completed, making the process more efficient. Finally, lean accounting aligns financial measures with value streams and supports continuous improvement in JIT operations, ensuring that accounting reflects the actual flow and value creation within the business. These concepts together help streamline operations, reduce waste, and improve cost management. Now that we've covered the material, let's summarize what you can do moving forward. You're now able to identify different inventory cost categories and apply the economic order quantity, or EOQ, to optimize ordering. You can compare material requirements planning with just-in-time systems, understanding their benefits and trade-offs. Additionally, you can explain backflush costing and lean accounting principles, which simplify financial tracking in lean operations. Why does this matter? These tools aren't just theoretical, they help improve cost control by making inventory management more precise and efficient. They reduce waste, speed up production flow, and ultimately strengthen your company's competitive advantage, especially in purchasing, production, and accounting functions. For your next step, I recommend working through the chapter application exercise. Practice calculating EOQ, assess how a JIT environment operates, and follow how backflush costing impacts inventory records. This hands-on experience will reinforce your understanding and prepare you to apply these concepts in the real world. This chapter has taken us from understanding inventory cost drivers to exploring JIT, backflush costing, and lean accounting, giving you a solid foundation for better inventory management and costing methods.